Inflation and rising interest rates continue to cause a downward growth trajectory in the property market. According to the latest FNB Residential Property Barometer, annual growth decreased in May, averaging at 1.9%. That's down from the 2.1% recorded the previous month. Senior FNB economist Siphamandla Mkhwanazi speaks to us now. Thank you so much for your time, Siphamandla. Let's first talk through what this particular report is telling us and the attributing factors here.
Sure. Good morning, Dumisang, and good morning to your viewers. Yes, we continue to see this high living cost pressures, high interest rate pressures on the property market, which is having an impact on particularly homeowners or aspiring homeowners in the lower end of the market. The results of our survey, of our second quarter survey, estate agent survey, suggest that we are seeing an increase in volumes in the lower end of the market of those who are thought to be selling their property because they want to downscale. They are looking for cheaper alternatives. Now, this has had an impact on the market in the sense that properties are now taking much longer to sell in the market, and more sellers have had to cut their asking price in order to facilitate a sale on their property, and all of that is having a downward impact on the value of properties or price growth in the residential property market.
With that said, home buyers selling their assets in this regard, what's to be said about those who are in a position to buy? How is that dynamic, filtering into the rest of the market activity?
Yeah, so we are actually seeing a divergence in the trend of those who want to sell and those who actually want to buy. So in other words, the demand-supply dynamic in the market is at the moment is a little bit disjoint. There are more sellers than there are buyers. So if you look at if you drive around, you will see a lot of for sale signs in many of, especially in the Johannesburg side, many of those suburbs, which is where we are seeing much of this pressure coming through. It's mostly Gauteng as well as KZN for different reasons, of course. So that balance between demand and supply is suggesting that we are actually finding much more supply than there are buyers in the market. So it's partly an impact of interest rates in the sense that those who are aspirant buyers have decided to take a wait and assess approach. They are not entering into the market due to the uncertainty of the future interest rate path. So it appears that they want to see some stabilization in interest rate, or at least a reduction in interest rate before they jump back into the market.
A skewed picture indeed, but what does it say about then the overall health of the property market in the residential sector in South Africa currently?
Right. So indeed, the strength of the market is weakening due to that imbalance between supply and demand. We do expect house price growth to average somewhere around 2% this year, and risks to this view are still skewed to the downside, and that is dependent on what interest rates do from this point onwards. I do have to point out to Dumisang that the price growth across price segment is it varies quite markedly. For instance, if you have a property that is valued somewhere just below 750,000, you are still seeing a pretty decent growth in the value of your property. It's actually above the rate of inflation. But the higher you go, especially when you hit that 5 million mark and upwards, we are seeing significant marked decline in property prices in a range of around about 4% and all the way to double digits if your property is valued 10 million and above. And those properties in the main are largely affected by the lack of sentiment in the market or negative sentiment in the market. It matters much more than interest rates, which drives property prices much more in the low to the middle segment of the market. So those in the higher end of the market, sentiment at the moment appears to be a significant driver of those price declines.
Now, Siphamandla, the rental property space is also one to look at if homeowners are selling and there aren't enough buyers who are maybe taking that wait-and-see approach when it comes to interest rates and maybe a big purchase item like getting a house, a property and the likes is not particularly immediate. What is the rental property market absorbing of this particular gap within the sector?
Yeah, it's an interesting question, Dumisak. So there are two things that we need to think about when you think of the rental market. The first one is the occupancy rate. So the rate of vacancies, the number of flats that are sitting vacant without tenants. And the second one is the ability of landlords to increase rental prices. Now, on the first one, this interest rate dynamic is actually playing in favor of the rental market insofar as occupancy rate is concerned. So those who are delaying their buying purchases are preferring to rent, or those who are dissuaded by the level of interest rate at the moment, who are taking this wait-and-see approach, are diverted into the rental market. So it helps the rental market insofar as the rate of occupancy is concerned. However, we are still talking about the same consumer that is facing high living costs, high electricity costs, high food prices, and they are sensitive to price increases. So even though we are seeing an improvement in occupancy rates, landlords are still finding it difficult to increase in rental prices. And as a result, you will see rental inflation is still languishing in single digits, below 5% at the moment. Because the overall household that is facing financial pressure at the moment. So yes, it is a support, but it doesn't go all the way to giving landlords full power to increase interest rate, to increase rental prices willy-nilly.
Thank you so much for your contributions. Siphamandla Mkhwanazi is an FNB economist talking to us there about their latest property barometer for the residential living space. The negative sentiment there continuing as a result of inflation as well as rising interest rates.